If your home insurance premium doubled at your last renewal and you just paid it, you may have overpaid. Not because the increase wasn't real, but because most homeowners who receive a doubled premium do one of two things. They pay it without question, or they cancel and switch without understanding why it happened. Both responses leave money on the table. I've spent nearly a decade reviewing residential insurance files in the Canadian insurance industry. I've seen exactly what drives premium increases, and I've seen which homeowners successfully push back on them and which ones don't. 4 questions. Why did it increase? Whether the increase is legitimate, whether your risk profile has changed, and whether your current insurer is still giving you a competitive rate. Answer those 4 questions in order, and you will know exactly what to do next. Let's get into it. Before you call your broker or start comparing quotes, you need to understand what category of premium increase you're dealing with, because the right response depends entirely on the cause. Here is how to identify which one you're dealing with and what to do about each. Question 1. Why did my premium increase? The first step is to get the explanation in writing. Call your broker and ask specifically what drove the increase at renewal. A good broker should be able to give you a clear answer, or request the underwriting rationale from the insurer directly. The explanation will typically point to one of 3 things. Category 1. Market-wide repricing. This means the insurer has raised rates across an entire geographic area or property category, not because of anything specific to your property, but because their overall claims experience in your region has deteriorated. If this is the cause, switching insurers may help, but only if competitors haven't repriced the same risk. The comparison still matters, but in a market-wide event, the gap between insurers may be smaller than you expect. Category 2. Property-specific risk flag. This means something about your specific property triggered an underwriting review, a claim on your file, a property inspection that surfaced a concern, or a change in your coverage that prompted a closer look at your risk profile. If your insurer flagged a specific property risk, an aging roof, older electrical, a recent claim, addressing that risk directly is what changes your premium trajectory. Switching insurers without addressing the underlying issue just transfers the same risk profile to a new insurer who will eventually price it the same way. Category 3. Loyalty penalty. In some cases, retained customers can end up paying more than new customers because insurers know many homeowners renew passively. If you have been with the same insurer for 5 or more years without shopping your renewal, a significant portion of your increase may be a loyalty surcharge rather than a reflection of any actual change in your risk. The loyalty penalty is the most actionable category because the fix is straightforward: shop the market. A comparison takes 3 minutes and tells you immediately whether your current insurer is pricing you competitively or counting on your inertia. Now, once you know which category you're in, the next 2 questions tell you whether you have leverage and what to do with it. Question 2. Is the increase legitimate? Once you have the explanation, evaluate it. A legitimate increase is one where the insurer can point to a specific, documented reason that maps to a real change in your risk profile or their cost base. A questionable increase is one where the explanation is vague, rates have gone up with no further detail, or where the percentage increase is significantly larger than what comparable homeowners in your area are experiencing. Run a comparison. Get quotes from 2 or 3 other insurers for the same coverage. The market rate is the benchmark. If your current insurer is 30 to 40% above market on the same coverage, that may not be a pure market increase. It may be a loyalty penalty. If the increase is legitimate, documented, proportionate, and consistent with market conditions, your options are more limited. The focus shifts to question 3, whether you can address the underlying risk factors that are driving the price. Question 3. Have your risk factors changed? If your insurer cited a specific property risk as the driver, the next question is whether that risk has changed since the file was last reviewed, or whether there are improvements you have made that the insurer doesn't know about. Property improvements do not flow automatically into an underwriting file. A new roof, updated electrical, replaced plumbing, removed oil tank. If you have made any of these improvements and your broker doesn't have the documentation on file, your insurer is pricing you as if the old risk is still there. This is one of the most common sources of overpayment I saw in underwriting files. A homeowner replaced their roof 3 years ago, never told their broker, and has been paying a flagged roof premium ever since. The fix is a phone call and a contractor's certificate. Question 4. Is your current insurer still competitive? The final question applies regardless of which category of increase you're dealing with. Run a market comparison. Get quotes for your exact coverage from at least 2 other Canadian insurers. This takes 3 minutes on a rate comparison site. The number you're looking for is the gap between your current renewal rate and the best alternative rate for the same coverage. If the gap is under 10%, stay. Switching has friction. New application, new inspection risk, new relationship to build. A 10% saving rarely justifies the disruption. If the gap is 15 to 20% or more, the conversation changes. That's typically several $100s per year on a standard Canadian home insurance policy. At that level, switching is worth the friction. But do it correctly. Confirm your new policy is fully in force before cancelling the old one. Never let your coverage lapse even for a single day. Before you switch, call your current insurer and tell them you have a competitive quote. Ask if they can match it. Some insurers will adjust, many won't. But the ask costs you nothing and occasionally produces a result without the friction of switching. Here is the reframe that changes how you approach this every year going forward. Your insurer is not a passive financial relationship. It is an active one, and the homeowners who treat it actively consistently pay less than the ones who treat it as an automatic transaction. Active means reviewing your renewal every year, asking why it changed, updating your broker when your property improves and shopping the market, not just when the increase is large enough to force your hand. The homeowners who pay the most for home insurance are rarely the highest risk ones. They are the most passive ones. The ones who assume the renewal is fair because it arrived in an envelope from an institution. Your premium is negotiable, not in the sense that you can demand an arbitrary number, but in the sense that documented improvements, competitive benchmarking, and an informed conversation with your broker can move it, sometimes significantly. Step 1. Request the explanation in writing. Call your broker and ask specifically what drove the increase at renewal. Step 2. Audit your property risk factors. Review the 6 risk factors covered in video 4 on this channel: roof age, electrical, plumbing, heating, liability features, and claims history. For each one, know what your file says and know what your property actually is. Any discrepancy is leverage. I've put a free homeowner underwriting checklist in the description that walks through those 6 risk factors one by one. Step 3. Document every improvement. If you have made any property improvements since your last renewal, new roof, updated wiring, replaced plumbing, removed an oil tank, get the contractor's certificate and give it to your broker. Ask for a premium review with the updated information. This is one of the most consistently underused levers available to Canadian homeowners. Step 4. Shop the market. Run a comparison before you accept the renewal. 3 minutes. At least 2 competing quotes for the same coverage. The gap between your current rate and the market rate is your benchmark for negotiation or the trigger for switching. Step 5. Negotiate before accepting. If you have a competitive quote, call your current insurer before switching. Ask them to match it. Bring the documentation of your property improvements. Ask what it would take to get your premium back to where it was. Some insurers will adjust, many won't. But the negotiation costs you nothing and occasionally saves you the friction of switching. The link in the description runs a home insurance comparison across multiple Canadian providers. It takes 3 minutes and gives you the benchmark number your current insurer should be beating. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. Previous videos are linked at the end. See you next week.